This video will be about trading versus investing, broadly speaking, and more specifically, it will be about are you trading or investing when it comes to Bitcoin? Are you trading or investing when it comes to altcoins if you happen to own any altcoins? This is a very important question to ask, and the danger is when you think you're investing and you're actually trading. Because if you need to know the rules of the game that you are playing. If you think you're playing a different game than the one you're actually playing, well, you're setting yourself up to lose, obviously. And if you are investing, so if you own Bitcoin and you consider it an investment, what is the ideal holding period for that? How long should you hold it before you sell it? Well, this is a trick question, and we'll get into that a little later. But first, trading versus investing. When you are investing, you are buying an asset that you're buying it because one way or another you believe that it is worth holding. It is going to increase in value one way or the other, either through capital appreciation or through dividends, or through some other mechanism of return. Your investment needs to appreciate in value by some mechanism, and there's various mechanisms that investments can do this. You could invest in farmland, and the return on your investment is calories. If you are growing your own food, if you invest in a woodlot, your return on investment is firewood. So investments can have various mechanisms of return, but ultimately, the reason why you are holding it is because it is intrinsically valuable. It is intrinsically an asset that is going to hold and appreciate in value. And if you are trading, you're not really caring about any of these things. If you are trading, you are playing an entirely different game. You don't care really about the underlying value of the object that you are trading. Not really. You're merely playing a game in which you buy some asset and then you sell it for a higher price to another trader, or theoretically to another investor that wants to buy it from you. But the idea is that the profit you make was not generated from any from the intrinsic value of that asset itself. It's purely, the profit is purely from it's gained from the other trader. Trading is a zero-sum game. Any profit that is generated by trading comes at the expense of another trader. This is very important to internalize. Trading is not productive in and of itself. An asset, an investment asset, let's say like agricultural land, it does not require someone to lose for it to generate a profit, a yield measured in calories, whatever crop or whatever that you're generating. No one loses when that productive land generates a yield. When a stock issues a dividend, and that's how you are realizing the capital appreciation with that asset, the dividend comes from profit. And profit is not a zero-sum game. For a company to generate a profit, it does not require that someone is the loser. When, let's say, Apple creates iPhones and people pay Apple for the iPhone, everyone's happy with that transaction. People get a phone that they love. They love the brand. They love the interface. They love the product, basically. I'm personally not an Apple fan, but clearly a lot of people really love Apple. And when they gave their money willingly to Apple for that product, they did not lose. They gained. They gained something that they wanted. And on the flip side, Apple is not a loser either. They are making a profit. So when a company like Apple creates a profit, there's no loser in that sense. And now we can talk about externalities. There is situations where someone external to this trade can be hurt, yes, and that's a different topic. But if we're talking purely about Apple as an asset, the stock as an asset, the dividend that it generates is not, it does not require someone to lose for it to be generated. And this is the essence with an investment. Investments are not zero sum. They don't require a loser for them to appreciate in value. Trading does. With trading, you're playing a game where if you are successful, it is because someone else was unsuccessful. And you are betting, literally, that you are going to be one of the people that is successful. And the thing with trading is it's not 50-50. It's not that 50% of people lose, 50% of people gain. It's more like 1% ultimately are the really successful traders, and they are profiting off the 99% as an aggregate. And in the end, most people who are traders, in the end, they lose. They are losers. It is just like multi-level marketing. Most people who engage in multi-level marketing, they lose money because that's the nature of the game. The problem with multi-level marketing is people do not realize the game that they're playing. They don't realize that the game is zero sum. That in order for the whole scheme to work, 90% of people must be losers. It's just objectively how it works. Well, same with trading. That's the game that you're playing. I recommend a book by Jack Bogle called The Little Book of Common Sense Investing. It's a spectacular book. I don't personally own any stocks. I don't think that it's a good idea to own stocks right now. But the information just about investing in general is really, really useful in this book. And Jack Bogle, he says in the book, over the short run, illusory speculative returns caused by the impact of the change in the amount investors are willing to pay for each dollar of corporate earnings can increase or decrease investment returns. But, and this is the important part, in the long run, the impact of speculative returns washes out. And in another section, just to reinforce this idea, he says, recall that the century-plus nominal investment returns earned by stocks was 9.5%, consisting of an average dividend yield of 4.5% and an average annual earnings growth of 5%, which equals 9.5%, a mere 0.1% per year. A mere 0.1% per year was speculative return, essentially zero, for a total annual return of 9.6%. What is he saying here? He's saying that the stock market over the long term, it has returned almost precisely what the sum of the capital appreciation plus dividends has been through corporate earnings. The stock market, you don't make money from stocks by trading them. That's not the point of stocks. You make money because the corporations that stocks that shares represent ownership of, the underlying corporation that goes out in the real world and creates products and provides services and creates profits. This is what provides the returns of the stock market over the long run. With the stock market, what you really need to be doing is investing for those reasons, not trying to trade, because on a net basis, trading basically provides 0% excess return over the long run. Okay? So the same applies to Bitcoin. Now, Bitcoin does not have the same return mechanism that stocks do. So that is different, but the principle applies. If you hold Bitcoin, you are holding it for reasons other than thinking that you can just sell it to someone else in the future for more money, because that would just be trading. That is not why I hold Bitcoin. I believe that you can hold Bitcoin forever. You never have to sell it, because its return mechanism, its underlying value proposition, does not require that you sell it in order to experience capital appreciation with this asset. Now, it does not have a dividend. Yes, that's definitely the case. Bitcoin is in a different category than stocks. You have to calculate its return mechanism in a different way. Just like with real estate, you have to calculate real estate returns differently than you have to calculate them with stocks. Same with bonds. These are different assets. You calculate them as investments in different ways. Now, the important thing to stress here is that if you have, let's say, an altcoin that you are holding because you think it's an investment, you have to ask yourself, what is the return mechanism of this asset? And if it does not have a viable capital appreciation mechanism, or some way that it appreciates in value other than just hoping you can sell it to someone else, it's just a horse to bet on. That's all it is. To look at meme coins like Shiba Inu, this is nothing more than going down to your local horse track and putting some money down on a horse. It's actually even less than that, because at least there's some form of you can at least analyze the different horses and try to maybe try to get some edge. There at least is some possibility of gaining an edge on other gamblers. But when it comes to something like meme coins or shit coins, Shiba Inu or whatever, or most of the altcoins, really all it is a game of hype, marketing, speculation, in many cases insider trading. It's all just about pumping up a coin in order to sell it, to dump it on someone else. Now, you could say, why don't I apply this same logic to Bitcoin? Because after all, with Bitcoin, because there's no dividend, because there's no income, how is it that one can buy Bitcoin and hold it and never sell it? And how can that be an investment? How do you gain from it? Why does Bitcoin appreciate in capital value? Why does it not just rely upon selling it to the greater fool? Right. This is one of the biggest criticisms of Bitcoin, is that it relies upon selling it to the greatest fool. Well, the underlying reason why Bitcoin is an investment is the investment thesis is that it is monetizing. That is the core thing that must be understood about Bitcoin. If Bitcoin is not in the process of monetization, you should not buy it. It is not an investment. It really is, in that case, just something that you dump on someone, on the greater fool, and you extract your profit from them. If Bitcoin is not in the process of becoming money, if it's not in the process of monetizing, then it's not an investment. However, I feel very strongly, and I have put my money where my mouth is, that Bitcoin is in the process of monetizing. I believe it's the only thing that explains the exponential rise in Bitcoin's in its fiat price, in its network growth, in its hash rate, in its institutional adoption. It's a household name. Everyone in the world knows what Bitcoin is. All of these things put together in the aggregate, I believe, suggests that Bitcoin is in the process of monetizing. Just in the very same way that gold monetized thousands of years ago, except it's happening on a very compressed timeline. And if that is the case, then Bitcoin really is an investment. It is not just relying upon the greater fool. Why? Well, because of the way money, real money, hard money, works. Especially a hard money that has ultimately zero inflation, that has a hard cap on its supply. Then the return mechanism is not through dividends, it is through capital appreciation. The way it works is that money is only as valuable as all the goods and services in a given economy that it is used, that it serves to measure the value of. And to the extent that all the goods and services in that given economy continue to become more productive, continue to accumulate more value, well, that automatically confers an increased value of the money. Because this really is what deflation is. And this is kind of the secret that central banks don't want you to know, because central banks are just so afraid of deflation. But deflation in this sense, what it is, it's an increase in the purchasing power of the money, because if the money is static but productivity in the economy grows, well, then the purchasing power of that money grows as well, because the money is the divisor. It is what is dividing everything that is available in the economy to serve as capital, to serve as value. And to the extent that all of that, those collected goods and services and capital continue to increase in value, so does the value of the money. That is how money returns, real money, hard money. That's how it returns basically a profit to the investor. It's through capital appreciation, through this mechanism. Okay? This is the investment thesis of Bitcoin, or really any money, any real hard money at all. And there's particularly a motivation to own hard money before it has fully monetized, because then you really get to appreciate your capital. You really get to benefit from the process of monetization. And that's why I don't own stocks. That's why I don't really own any other investment. It is my largest asset for this reason, because of the opportunity cost, because Bitcoin is in the process, so early in the process of monetization. It's hard for me to justify any other investment. Yeah. And ultimately, with Bitcoin, I'm investing in it. I never have to sell it. To the extent that I am correct about my investment thesis, to the extent that Bitcoin is money and it is monetizing, theoretically I can hold it forever. And that is, for me, the litmus test of any investment. If you can't hold an investment forever, why are you buying it? Well, you're buying it because you plan to trade it. And if you're merely buying an asset to trade it, you have to recognize that's fine. Go ahead and do it, but recognize that you are playing a different game. You're not investing, you are trading. And also, I would say, analyze the underlying asset and ask yourself, does this have any intrinsic value? And what I mean specifically by that is, does it have any way, any mechanism of returning value to the investor without them having to sell it? Because if the answer is no, then not only are you not investing, but you're not even trading. You are simply gambling.